now calling Mike, and we are entering the new world of carbon trading. Mike, I'm pulling up your presentation. Yes, here we go. Over to Mike.
Wonderful. Thank you, Matthias. As introduced, my name is Michael Azlen. I'm the founder and CEO at Carbon Cap Management. We run the World Carbon Fund. This is a fund that invests in the liquid and regulated carbon markets on an absolute return basis. And I only have a very few slides today, but I would echo the comments of the previous presenters in terms of past returns do not indicate future returns. And the other standard risk disclaimers. Our fund is also only available to sophisticated investors. As a quick summary, and carbon is an asset class that certainly is beginning to emerge. Our approach to carbon is to target absolute returns, and we also have a direct impact on climate change. My background, I'll tell you a little bit more, but this firm is backed by a Swiss private bank. And a very experienced management team. The investment team have years of experience in carbon pricing, carbon trading, and portfolio management. Interesting, unlike other asset classes, carbon is traded by end users, so steel companies and cement companies in the regulated markets, and that creates significant alpha opportunities. You may not be aware, but carbon markets are now deep and liquid. With liquid futures and options markets, we're trading between $2 to $4 billion daily in these markets. We expect this to be in excess of 5 to 10 billion daily traded value as new carbon markets open in the coming 24 months. Our fund was launched in March of 2020, so we have a 20-month track record now. We're up 68% since launch and up 54% year to date. We're running 75 million AUM, or perhaps close to 80 million now in AUM. And after a 3-month due diligence process, we've just onboarded a very well-known, our first well-known US institutional investor with a $20 million investment. What do we hold in the fund? It's mainly listed futures and options with daily liquidity, and we hold some physical carbon in addition. A little bit about the team. So I said I would expand on my background. I'm Canadian. I've been in London now 25 years. Myself and my partner, Colin Hodges, we built our previous asset management business to over 700 million, and we were very fortunate to achieve a sale of the business to a Swiss public company. Upon doing a deep dive after that earnout period, a deep dive into climate change, I've now read 33 books and more than 200 academic papers on the subject of climate change. I really became committed to do something in the space. And that prompted me to hire a PhD student from the LSE here in London to put together a comprehensive research piece on carbon as a liquid and investable asset class. That paper has been picked up and published by the CFA Institute. It's available on our website. And really that formed the foundation for the business today. We put together an excellent team. Edward Bratton has been trading carbon at Merrill Lynch on the sell side and at Gazprom on the buy side for more than 15 years. Ed brings a huge amount of experience in this asset class to the team, both on sort of the long only side, but also on the long short and on the arbitrage and alpha side. And there are really interesting arbitrage opportunities in carbon. Alex Child is our head of research. Alex was on the team at Vivid Economics, a consultancy here in Europe that has recently now been bought by McKinsey. That team advised the European government on the finer points of the mechanism of how the European carbon market functions. And the European market is the leading carbon market in the world, trading about 2 or 3 billion a day. Very, very liquid, very successful market. Our total team is 8 people. So, I think the key team is here in terms of carbon trading and carbon pricing and portfolio and risk management. Cap and trade, you may not be familiar with, but cap and trade is a very efficient policy tool to address climate change. I think it's really important to make a differentiation between the voluntary carbon market and the compliance market, the regulated market where we invest. The voluntary market is where someone will plant trees, or they'll have a project that relates to reducing emissions. An independent company will verify those emissions and issue carbon credits or offsets. That market is growing, but the voluntary market is today unregulated, not liquid, small in size, opaque, and most importantly, there's an unlimited supply of carbon credits and offsets. More projects are launching all the time. We're not involved in that market. There are some good projects in the voluntary market, but where we are investing is in the government regulated markets. So those markets are highly regulated, very liquid, very large in size. The difference between these two different carbon markets is about 1,000-fold difference. So it's not 10 times different. It's about 1,000 times difference in size, complete transparency in the regulated carbon markets. And I think most importantly, there's a cap on the number of permits, and that cap is lowered every year, creating scarcity for the underlying permits. I don't have time today to go into the efficacy of how a carbon market achieves its objectives of capping and lowering carbon emissions to address climate change, but doing so at the lowest cost to society. It is a very, very efficient policy tool. And in this regard, really the proof is in the pudding. In Europe, since the carbon market was implemented, emissions have dropped 1 billion metric tons per year. And in our global world of 40 gigatons, 40 billion tons, reducing emissions by 1 billion, this is moving the needle. And for those of you who are focused on climate change as an issue, you're probably aware that we are running out of time on the issue if we are to achieve the Paris Agreement objectives. And therefore, this is one of the, I feel, only policy tools that can achieve this at scale. That success in Europe is spreading around the world. Most notably, today we're invested in 5 global carbon markets: the European market, the UK market, which launched earlier this year due to Brexit, the California market, which is linked with Quebec in Canada on the west coast of the US. On the East Coast, there's the Regional Greenhouse Gas Initiative. That's 11 states on the East Coast. New Jersey joined in 2020, and Virginia joined this year, and Pennsylvania hopefully will join next year. So these markets are expanding. The 5th market we're invested in is New Zealand. This is a small market, but a very well-run and disciplined carbon market, and we really like that market. But the big news is China. After 8 years of running pilot regional carbon markets, which are still trading today, China launched their national carbon market in the summer. It covers 5 billion metric tons. So that's really moving the needle. And that market we expect to be onboarding into the fund perhaps next year. It's still a bit early. We'd like to see some more development, some more transparency, some more liquidity in the market, but it's going to be a very big part of the future. Interestingly, Korea is opening up to international investors. Mexico is already running their pilot. And just recently, Brazil is moving legislation through to launch a national carbon market. Malaysia just announced 4 weeks ago they're launching a national carbon market, and there's another dozen countries around the world. So with the focus on climate change policy and trying to address that, we really feel a market-based mechanism where we control the supply, but we let the market determine the price of carbon is a very efficient way to address climate change at scale. As I mentioned, when I first learned of these carbon markets, carbon was trading at the time about $500 million a day. Today, we're trading 3 to 4 billion per day. And I think most pundits are forecasting will be trading in excess of 10 billion daily in this asset class quite soon when China, Korea, and other markets open. I was intrigued, and I tried to find the historical return, volatility, and correlation properties of carbon, but the data did not exist. So I hired a PhD student, and we have written an academic paper called the Carbon Risk Premium. And I'll just give you the highlights of that research that has now been published as a CFA case study. Carbon as an asset class over the last 8 years has been appreciating at approximately 20% per year, with volatility of 15 to 20%. So it's quite a volatile, can be a volatile asset class. But the key thing was very, very low correlation, both between carbon markets, even though they cover the same product, 1 ton of CO2, but also carbon with all other asset classes. And you can see that on this correlation matrix here. A carbon permit in California is not fungible in the European carbon market, and therefore cross arbitrage capability does not exist. So each market is driven by its own dynamics, energy prices, the state of decarbonization in that market. And that means there's very low correlation. And of course, this has portfolio construction implications for diversifying across a basket of uncorrelated assets. The World Carbon Fund, we have 2 objectives with the fund. The first is quite standard. Over any 12-month rolling window, we want to be positive. We really have an absolute return profile to the fund, so we can have down months or down quarters, but over a 12-month period, we always want to be positive. And the second objective is to have an actual impact on climate change. And we do that in a number of ways, but the hardest impact is that 20% of performance fees are committed to purchasing carbon and permanently canceling or retiring those permits. Our investment process, I'll skip the first 2 steps here because of time. Our investment process, I really want to focus on 3 things. First, carbon is volatile because it's linked to electricity. Most of carbon emissions come from electric utilities. They burn coal and gas, of course, to make electricity. Renewable is coming onto the grid increasingly, but currently most emissions emanate from utilities. They produce electricity, which of course you cannot store until we get industrial battery storage coming onto the grid. And so electricity is volatile, and that knocks on to carbon volatility. European carbon has 50% standard deviation, 50. That's quite volatile. And when we set up to launch the fund, we decided to impose a hard cap on volatility, and that is 2.2% daily VAR at a 97.5 confidence interval. What does that mean in practical terms? About 15 volatility, long run stock market vol. So we're aiming for 15 vol and 13 to 15 annualized return with a very low correlation to other asset classes. That risk budget, we must calculate, and we must be below that VAR number every day, and indeed we are. We report that to a third-party regulated compliance entity, and we allocate the budget to 2 very complementary strategies. So it's 1 fund, but 2 strategies within the fund. The first strategy we call our core long plus hedges, but perhaps a better name is core long plus convexity. So here we use futures and options. We do deep fundamental research on each carbon market in an attempt to overweight or underweight those markets with the most attractive return profile, and we use options to create convexity on the upside if we have a high conviction view, or we'll use options to protect on the downside if there's a policy event or a regulatory event that we feel poses a risk to the downside. So this is a long bias strategy. The alpha strategies stem from the fact that most carbon is traded by steel companies, cement companies, and this creates alpha opportunities. So just to wrap up, the fund is 20 months old now. As I mentioned, November is also a very, very strong month. So we're up about 54% this year. You can see here the traded value of carbon has really increased in only just the last 12 months. And I would ask you to look at the website for a lot more educational materials that we have available, including a webinar where we go into a lot more detail. Thank you very much.
Great. Thank you, Michael.